Okay, can everybody see that?
Yes, sir.
Okay, thank
Yes,
you.
I can see it.
Okay, just wanted to make sure, whoops, going a little fast. Hey, as mentioned, this is before, this is for educational purposes and meant to be a discussion, so please ask questions as you can, but this is neither supported or sanctioned by Viasat, but did get permission. But like I said, this isn't specific advice or recommendations, but hopefully it's helpful, helpful to people. And since we can't put this on the corporate website, I'm looking to put the recordings and slides just on like probably a personal website, and just want to make sure nobody had any issues with that as well. The other thing, if you guys don't mind, like actually showing video, it's helpful to me because then I can see what people their reactions, if they're bored or not, or if things don't seem to make sense. If they're falling asleep, I'll know to move on. But it helps me, making sure I'm not just wasting everybody's time. Like if you didn't attend the last one, this is, like I said, I'm not up here preaching. I don't know everything, but I've made plenty of mistakes, as you can see, and hopefully I've learned from those mistakes and trying to keep really pass on what I've learned and hopefully get people, if they're not already on the right track as fast as possible. So, okay, last week we covered part one. A couple of these we'll touch on again, but now we're just going into this second part where we're kind of talking more just about specifically investing and certain things I've seen along the way, and and also kind of defining between saving and investing, speculating, day trading, etc. Okay, and here's the specific topics. Okay, okay, this is what I wanted to touch on. We had mentioned this before, and Stephen, you had actually mentioned, you're like, hey, how do we determine what we need for, how much do we need to retire on? And I felt like I kind of skipped through that really quickly, so I wanted to retouch back on it. Like you'll notice a lot of places, even I think, when I've looked at Empower, they talk about like 80% of your income, which that's, like replacing 80% of your income. I don't think that's as good of a metric as determining what your actual expenses are in retirement, which will change a bit, but you could do quite a good estimate. And then what you ultimately to become financially independent, there's actually multiple studies they've done. The first one was actually by Bill Bengen, and he did in 1994, was the first person that came up with the 4% rule. Which is, he was looking at historical numbers from 1926 onward, and he came up with 4.2%. That was followed up by the Trinity study, which was the college, and they did a study that was released in 1998, basically came up with the same things. These were they used a little different, it was Bill Bengen took it like 50% stocks, like basically S&P 500 index fund, and 50% intermediate treasuries as bonds as that. And then he looked at allocations from 10% stocks up to 90% stocks, and actually found the sweet spot was between 40 and 70. But it was just he used initially just that base allocation, and the Trinity study actually used similar 50-50. But they used like corporate bonds and stuff like that. So similar, but a little bit different. But what's pretty interesting is they both came up with the same thing. This 4% rule, rule of thumb, meaning you could, and it's inflation adjusted. So you really need to know, meaning you could take out 4% from your, cash out 4% of your retirement portfolio that first year, And the returns would continue to make enough money to where you wouldn't run out of money for at least 30 years. As people try to push, retire early and push that out, there's questions of, hey, do I need to drop this down? And there's a lot of studies that are kind of still going on about this, but they've pretty much shown that a 3.33% works for 100% of the time with a 3.33% withdrawal rate. This is all inflation adjusted though, so each year as inflation goes up, you add that dollar amount associated with inflation and keep withdrawing that. It's not like you keep just drawing that same 4%, each time. But it's pretty interesting. I don't think it's a good way to actually set up your actually withdrawing from retirement, but it really gives you a good way to determine, are you financially free? If you've got figured out what your yearly expenses are, multiply that by 25. If you've got that pool of money, not sitting in cash, but invested appropriately, you're financially independent. Be a little more conservative. You can obviously increase that a little bit, but it's a good rule of thumb. But I think there's much better ways to actually withdraw that money down the road, so that you don't end up, in this case, more than 50% of the time, people ended up with 4 times the amount of money they had when they began. And that's not, you don't, unless your whole thing is to pass it to heirs, you're not living your good life as much as you should. Any questions on that? Does that make sense?
What's the time here? So you can withdraw 4% over
every year.
Every year? Okay.
Every year. And so, Alyssa, the returns that you're going to get, like what they've shown is the market return is even inflation adjusted. Just this is the market, not bonds. Is inflation adjusted makes 7% a year historically, since for the last 100+ years. And so when you mix stocks and bonds and say 50-50, you will still have a rate of return high enough that it's making money to where you don't have to have any cash. You don't have to have a job or anything, because your money's making money. That return that you're getting from having that money invested will continue to compound, and so that you could keep pulling money 4% out, inflation adjusted every year, and you won't run out of money. At least they did it for 30 years, but they've shown, heck, if you drop it down a little bit, like a 0.5%, it works. It's asymptotic, and you'll never run out of money. And there's many times, depending on when you retire, this is looking at the worst time frames too in history. Like 1966 was the worst year to retire. Heavy inflation in the 70s, and combined with a couple big recessions. But other times, people could have spent 13% a year, 13% of their portfolio a year. Think about how much more you can do. So that's why I say it's a good rule of thumb of saying where you're at, but when you actually are going to distribute that money, there's better means than this. And that's where I guess it gets complicated. And that's something I actually am interested in, in studying. There's actually a certification on RACP that interested in getting, because it goes in depth. It's a new cert that's specifically studying that. And did I answer your question, Alyssa?
Yes, thank you.
Okay. Any other questions here?
Alan, if it's all tied up in your 401k, right, and you're 45 and not 65, it doesn't really do a whole. It does you a whole lot of good later in life, right? But not in the immediate.
You're right, and we'll kind of get into that. And actually, the next presentation I give specifically talks about that and how to get money early. And I talk about a little bit of this earlier, but we'll get into what I think is kind of the trifecta. You want your 401k, you want your IRA, but you also want your brokerage account, which I think of as a tow truck that gets you to, when you can actually use your retirement funds. But there are ways to get that retirement money early that we'll go into.
Gotcha.
Cool. Mm-hmm. Okay. Any other questions on this? Okay. and Bill Bangan's about to put out a new one, a new book that his basic latest research, and that's when he's going to finally retire. He's like 74 years old right now, but he's doing incredible research on this stuff. Amazing. I'll let you guys know when I get the when that comes out. Okay, here's like we were saying, Scott just had a good lead in. So how do you invest for retirement? There's several tax advantaged accounts, which we have as a 401k. There's a health savings account if you're on the high deductible plan, which is the best tax advantage plan there is, completely. And then individual retirement accounts. Does everybody in here have a Roth IRA? Or how about who does not have a Roth or a traditional IRA? Everybody does? Good. Okay. I think the Roth is the way to go, and especially it provides the most flexibility. And we'll get into those income. There are income limits actually on both, especially for us that have a 401k sponsored plan. Even on the traditional pre-tax, there's relatively low income limits of when you can deduct that money for taxes. So I'd say go Roth all the way, and then it provides huge flexibility because you don't have RMDs long term, and that tax-free growth is incredible. Also, taxable brokerage accounts. So some people are a big fan of just loading up completely your 401ks, but I think you always need some in a brokerage account. Get the match, get the ESPP, max out your Roth and HSAs if you can, but then you do want some brokerage account for those shorter long-term goals. And like Scott was saying, that's also that's money you can pull anytime, whether you want it for to retire early before you can have access to the actual tax advantage accounts that have the age limits. And here's some other kind of non-tax advantage accounts. I've mentioned Treasury Direct. I-bonds are pretty popular, and I like to think of those. They're a good inflation hedge, and more like a cash part as you get closer to retirement. They've got a great interest rate right now because inflation's out of too dang high. But those are a good hedge. Bonds, as interest rates go up, prices go down. But this is the I-bonds, you can only put $10,000 a year, but it's a good thing when I think of building up that cash bucket. It's almost like a better CD ladder with interest rates where they're at right now. And then I put crypto. Those you can't buy in typically in normal discount brokers. There's like FXUS, Coinbase, and stuff like that. But crypto is still a speculation. But it's I understand it. I just wouldn't put too much of your money in there. Okay, now I know these slides are quite wordy. It's more for the material.
All right, Alan, I have a
Yep.
question on the last slide.
Sure.
So you're talking about bonds, how it's a good time to buy when inflation is high. Is there like a good time to sell bonds as well?
Okay, so I was meaning really I-bonds, which are it's a savings bond that you get through Treasury Direct. Yep. Bonds in general, like for people young, I think they should be all equities because that's where you get your growth. As you get closer to retirement, you need to start allocating more to bonds, just because they're almost like ballast. They're not as volatile as the stocks, and so they smooth the ride, if that makes sense. And right now is not the time to buy bonds, especially for you, because we're in an interest rate rising environment. So bonds are going to prices are going to keep falling. So they're going to actually be worth less. So, but I-bonds are separate. Those you can do $10,000 a year, actually 15, like you can use $5,000 of a tax refund in there. But those you have to go right onto Treasury Direct and you buy those. And but you're limited to $10,000 a year. But I think of that as a good kind of like as you're filling up your cash bucket, that when you get closer to retirement, so that you have money, and it's inflation adjusted. That's a big concern with cash, right? Is you lose to inflation, but these are tied to inflation. So they update these interest rates every 6 months, and it went from 7.12 in November, and it just went to, I think, 9. It's nearly 10%, because inflation's so high. So to me, it's a good thing. It's almost, I think of it like a kind of an advanced cash CD ladder, if that makes sense. So, Alyssa, for bonds, the best thing, bonds do really well when interest rates start to drop, which is not where we're at right now. But you'll see that happens, like when recessions hit, that's what the Fed drops the interest rate, and then bonds will shoot up. Okay, so here's just going into numbers for the different accounts, just showing how much we can actually contribute. For the 401k, and other people have different 401a, TSP for the people in the military, all the same basic things, the same basic tax advantage. But you can contribute for 2022 up to $20,500. And then the year you turn 50, not when you're 50, but the year, you can add an additional $6,500 into that. And those can go in Roth or traditional, depends on the plan. Our plan allows for both, and any split that you want. And I put here what the max match would be. Like if your salary's high enough, that's what our max match could be. If you made $205,000 basically, that's how much you could get. But the actual end umbrella of this 401k is actually much larger. There's actually a total of 61,000 allowed, which that's if there's profit sharing, that could go into that. If you had your own small business, you could do like a solo 401k where you could take 25% of your profits and shove it in there. If a 401k plan allows it, there's something called the mega backdoor Roth that Congress is trying to cancel, but you can do after-tax contributions into this 401k umbrella. It's just sitting there, and then you invest it. And then the second item you need is in-service distributions, meaning the 401k plan allows you to transfer that money to a Roth IRA. It's a beautiful way to increase your, significantly increase your Roth contributions for life. And you could, if you had enough, you could shove another $30,000 a year. I mean, it's pretty amazing. And I don't know why companies don't do it, but don't offer that in their plans. Any questions here on just the overall 401k? This is your big, what I call the dump truck, because there's so much money you can put in compared to other accounts that have tax advantage. Okay, HSA. This is the best. This combines both the traditional and Roth. Does anybody have any questions on the difference between traditional pre-tax versus Roth, how that works? Okay, well, an HSA, you have to have the high deductible plan, but you can put in, single $3,650 or $7,300 if you're married. Obviously goes up if you're over actually 55. All the ages are different of when you can add plus up contributions. But this one, they don't tax the money on the way in. Unfortunately, California still taxes it, but so you get tax-free, it's tax deferred, then you have tax-free growth. And then when you pull it out, if you use it for a qualified medical expense, it's tax-free as well. So it's the best possible. And if you use it from your actual employer's plan, you also get out of FICA taxes as well. So it's pretty, and the key to do here is you pay for your medical expenses out of pocket, let this invest, and just keep track of all your expenses, like in Google, Google Docs or something like that. And then years later, you reimburse yourself for all those medical expenses after this money's compounded for 20, 30, 40 years. It's quite an incredible account. The only thing note is studies have shown that people on this plan don't go to the doctor as much. And like I said, don't let this kill you. Go to the doctor. All the money in the world's not going to matter if you're not around. So, okay, and then individual retirement accounts. This is what everybody should have, as well as the 401k. And like I said, I recommend the Roth. You see, there's income limits here. For California, it's not very high, relatively speaking, and you notice. So there's you see it's a range, so it's kind of a linear, going from 6,000 to 0, what you can contribute. But right now there's a backdoor Roth IRA that still works to convert money into your Roth IRA, and hopefully Congress is trying to get rid of that, but hopefully they don't, or they bump up this. What I think they need to do is really bump up the income limits as well. Here's why I say go Roth though, because a traditional IRA, if you have no employer plan, you can deduct that forever, and then you can deduct that from your taxes that year. That money all grows tax deferred, but then you pay taxes on it, income taxes, when you pull it out. Roth, you don't, it's after tax money. All growth is tax free, and when you pull it out. The $6,000 limit, they haven't updated that, unfortunately. But if you notice here on the traditional IRA with an employer plan, look at how low this limit is, to where you can have those contributions tax deductible, relatively low. So that's why I say screw the traditional, get the Roth, backdoor it if you're above the income limits, and get the tax-free growth instead of, since you can't take the tax deduction anyway on the traditional.
Alan, that 6,000
Yep.
there for like the Roth IRA married, is that 6,000 per married, like
Nope,
per tax return, or that's per person?
This is an individual retirement account. So
Yeah,
it's
okay.
only on the individual, it's not family. So everybody should have one. Husband and wife. This is even something you can get for your kids, a custodial Roth IRA when they start earning income. You do have to earn income, except for if you're, say you have a non-working spouse, they can contribute to their own IRA anyway, even though, so long as the husband makes at least 12,000, or husband or wife, so whoever's working, makes at least 12,000, each can contribute 6,000 into their own individual IRAs. Make sense?
Yep.
And everybody should have one. And everybody should have an Roth IRA and throw at least $1 in. I'll get into that more later. There's these weird 5-year rules, but everybody should have a Roth IRA started. And same with your 401k, Roth 401k. At least put $1 in, because that starts another 5-year clock. That's important to get the earnings on the growth tax free. Okay. Any other questions? Yep. What's that?
That MAGI acronym there.
Maggie. Yep.
What does that stand for?
It's modified adjusted gross income. So let me see.
So that takes into account, like, if you're contributing to a traditional 401k, you're reducing your taxable.
Yep. You're
reducing all that stuff.
Yeah, that's your adjusted gross income, is after you take any contributions you have that are tax deferred, like the 401k tax deferred, that subtracts from your gross income, gives your AGI, but your modified AGI actually adds some back in. So if you had tax-free bonds, like municipal bonds, interest and things from those get added back in to your AGI to get your modified AGI. Most people don't have hardly any of it. It's pretty much, your AGI is typically about your Maggie, but there is a little bit difference, and it makes it a little more restrictive than the AGI, if that makes sense.
Gotcha. Thanks.
And then from AGI and Maggie, or from AGI, then from that you subtract, for your taxes, most people use a standard deduction anymore, but it's your standard deduction or itemized deduction, and that provides your taxable income. Okay. Any other questions?
So that is what you're saying there is that 129 to 144 is your taxable income.
That's not your taxable income. That's your Maggie. That's your adjusted gross income. So if you take your gross income minus those contributions and there's a couple other things but most of us don't have that. They're like educator expenses and stuff like that, like $2,500. But mainly it's pretty much for people, it's their 401k tax deferred contributions that you subtract out from that gross income to come up with your AGI. And then you add back any municipal interest from municipal bonds, et cetera. And that comes up with your Maggie, which is what these are those numbers: 129K to 144K single, 204K to 214K married. The thing is, one of the slides goes in here, if you're above those limits though, or you think you're going to be, you can backdoor it, meaning you contribute all to a traditional IRA. And then when the money settles, you convert all that money into a Roth IRA. This works great so long as you don't have a bunch of money that's untaxed in a traditional IRA. Like if somebody's there, you get into a pro rata rule. I'll get into that more later. But that's if you already have a ton of money that hasn't been taxed in a traditional IRA, the backdoor doesn't work very well because you get taxed on a large portion of that money going in to the Roth. But I've got that on the next presentation that I give. Probably I've got a good explanation and drawings on that. Okay, I wanted to bring this up.
I have a couple questions.
Yep, sure.
If you go back, I wanted to understand why there was a range for the limit.
Okay, so
is that by state or something?
That's what the powers that be, the government decided, and so it's a phase out. So at $128,999, you can contribute $6,000. At 144K, you can contribute 0. So as you're in between that range, you can contribute some, it basically
like a percentage of 6,000.
Yeah, it's like a linear, exactly. You can if you do a little equation, you could figure out what you could contribute. But to make it easy, if you're close, if you're not close, don't worry about it, just put it all in Roth. If you think you might get into that, just backdoor it. Just do the traditional, in my opinion, and then move it right to the Roth if you don't have money in your traditional, because otherwise it gets too complicated. And I like to do it all at once. Because of that, I don't want to have to convert. Say you dollar cost average, every month you put in a contribution. Well, then you'd have to backdoor it 12 different times. Or the wise way, because I want to get the money in, backdoor it immediately while it's still in cash, get it in the Roth IRA, and then invest it. So it's all after-tax money anyway from your checking account, whatever. Then you put it in the traditional, immediately move it. That has had 0 growth, so you don't get taxed on any of that. That's the thing. If you have growth on that traditional IRA before you move it to the Roth, you're going to pay taxes on that growth. So that's why I just like to max out January 1st, put in the whole year's contribution, and then to traditional, move it right to the Roth, bam, invest it. Good, done. 2 steps, you're done. And you're maximizing time in the market and minimizing your own time doing these silly conversions. Did that answer it? Yep.
Yeah, and so if you do that backdoor method, you're not held to those income limits anymore?
Correct.
Okay, it's still 6,000, but you can be making, if your joint income is more than 214K, it's okay.
It's okay. Yep, you cannot contribute directly to the Roth, but what you can do is you can contribute to the traditional And then what you're doing is you're doing a conversion of that traditional to a Roth. And so there's different rules, 5-year rules on that as well. But it's a way to get around. It's the same amount of money, but it's the way to contribute to the Roth despite being above the income limits. If you're below the income limits, don't do this. Just contribute to the Roth, because contributions can be taken out immediately if you need to. Don't want anybody to do that. You want that money to sit and grow for many, many years. But that's the beauty of the Roth too, is you could, if you had to, in an emergency, you could pull out contributions immediately. And that's how they pull out. The first money that comes out of a Roth is contributions, then it's conversions, then it's earnings on contributions, then earnings on conversions. So it's set up well for people. They got some of these things right, at least. And is that any other questions, Alyssa, on that?
No, thank you.
Okay. And the next one I just want to bring up, because this is more for people that maybe have a significant other that maybe works at a nonprofit, hospital, state teacher. They have access to 457 plan, which is like it's same contribution limits that you could do each year, but there's no age limit on pulling these out. So Scott, going back to what you were saying about these qualified accounts, if somebody has access to this, what a beautiful account that can provide tax advantage, either tax deferred or Roth. Yet you can use this money when you're 30 if you wanted to, with no penalty. You can use the other money, but you're taking a penalty, so you might as well just burn that money, which is ridiculous. So you don't want to do that. But any questions on this? I just want to bring this up to make sure if anybody has family members, they're taking advantage of this, because a lot of people don't realize, and they miss out on years and years of being able to contribute to a 457. And it doesn't, you can contribute both, like that's the thing. You can, like the bumper you see, you can contribute both to the 457 and the other, typically for these nonprofits, state, et cetera, it's usually a 403B, which is the same as a 401k, but they can contribute 20,500 to both of these. Amazing. Okay, now going to, as you can see, I'm kind of a fan of the Roth IRA. But here's reasons why. Like I said, contributions, you can immediately pull that out. So if you had to, it could be used as an emergency fund. I don't want anybody to ever do that, but if you're having trouble early on, if people are trying to figure out, hey, can I only make so much money, what do I contribute to? Do I contribute to, I just want to build up my emergency fund, or do I start contributing to Roth? This is how you could contribute to your Roth, because as soon as that, you can contribute to a Roth IRA for the tax, let's say use 2021, the window just closed on tax day. So you can contribute to a Roth for that year up until tax day of 2022. So that next year. You can, but then once tax day, that window's closed. You can never, it's a pretty small limit on the amount of money you can put into an IRA. So, but as soon as that window closes, that closes. You cannot make up those contributions again later. So that's why, hey, if you're limited, say you could start contributing to a Roth, and if you really had to, you could pull that money out for an emergency fund, but you wouldn't lose you'd at least get it contributed before the window closes. The biggest, probably the biggest thing is no RMDs. This provides you flexibility on how you want to spend your money in retirement. Every other account, even a Roth 401k, you have to start taking money out at 72. There's a Secure Act 2.0 that's passed the House that I think that's going to change, push it out to like 75. It looks like over the next 10 years or something. But right now it's 72. All the other accounts you have to start taking, because IRS wants their money back. They've deferred these taxes for that long, and it's how they start getting their money back. But with the Roth IRA, you can decide when and how you want to spend that money. And then the other thing is Roth conversions. So during your gap years, as you're or even if you're on a sabbatical or something like that, you can start rolling money, converting money from traditional accounts, pre-tax accounts, into a Roth. you'll pay taxes on that as income, but that's the whole point. Like say in your gap year, say you retire, and before you start taking Social Security or have RMDs, and let's say you have no income, you can convert a decent amount of money each time in a very low tax bracket, get that into the Roth, then it grows tax-free forever, and also then lowers your RMDs in the future. Additionally, you can also get this money out of the Roth early. There's 5-year rules on it. Let me see if I've got a slide on that. Mad Scientist has a great Roth conversion ladder that he discusses. But hopefully everybody has their Roth open and funding it. Here's where, like I said, though, I think everybody needs both a traditional and a Roth. Ultimately, you'll need the traditional, maybe to roll your 401k into an IRA and then do conversions from the traditional IRA to the Roth IRA. But the other thing is, if you're above the income limits, this is how you do the back door, to where you open up a traditional, contribute the money, and then convert it, and you keep that account open. So it sits there at a zero balance, but you just keep it for the next year or the next time you're going to do a contribution, and but ultimately you're going to need both, and they'll let you sit there at a zero balance. They'll actually ask you when you do the conversion if you want to keep the account open or closed, and just keep it open. But anybody have any questions on this? This pretty much we've already kind of talked about already, but okay.
I have like
Yep.
Yeah, I was gonna say that flow from Mad Finance.
Yeah.
Maybe this
Yeah.
like a deep dive session on.
Exactly. And we will actually, Scott, I'm planning on one that it just go into the 5-year rules on Roths, because there's like several rules, and whether you're 59 and a half or younger, whether they're contributions, conversions, or earnings, there's a bunch of rules, and it's very confusing actually. So I'll do just a talk just on that, but that'll probably be, just that alone would probably be 30 minutes, and then there'll probably be enough questions for another 30 minutes. So, but this clickable Mad Scientist, he shows great steps. He's a guy, I think he retired at like 33 or something like that, but brilliant guy that determined the Roth conversion ladder, about contributing to your pre-tax accounts, retire early, and then you start transferring your money, and then it starts, each one of these conversions starts a 5-year clock on that money before you can start pulling it out. But you can do that. And they really did the 5-year, they forced that because before people could, you could always take out contributions, right, from the Roth at any point. Well, people realized, hey, I can just convert my traditional to a Roth and then immediately pull the money out. And they're like, wait a second, the government realized that, and they're like, nope. So if you're going to do a conversion, they're making you wait for 5 years until you can pull that money out and have the earnings tax-free. Make sense? Okay. Okay, here's Scott, this kind of goes into what we were talking about earlier. How do you get money out early? And I think of it, I put these in thirds. There's a number of thirds. It was just the easiest way to make the pie chart real quick. But you need some of each. Most people have way too much in traditional, but you want your brokerage account because that money you can take out at any time, and you only pay capital gains taxes, which is a lower tax rate, at least now. Roth, you never pay taxes on, 401k and IRA, and then your traditional. All your company match is always traditional. Congress is actually trying to change that as well, but the default typically in every plan is traditional pre-tax. So you have to go in and usually select Roth. But the next discussion too goes into Roth versus traditional, and why I think, in general, hey, when you're young and in a lower tax bracket, go Roth as much as you can. Then as your tax rate, as you start making more money and your tax rate gets higher, shift it, more to deferred, and then you can do conversions later. But we're in a relatively low tax rate history right now, and we know that's going away in the Tax Cuts and Jobs Act end by 2020, January 1st, 2026 at the latest. Likely, as you guys have all seen, they're trying to raise taxes much sooner than that. So this might go away. So it might be a good window right now to do more Roth additions, even if you're a little higher tax bracket than because you're going to be in a higher tax bracket very soon when that goes away. But here, this provides just flexibility on how you want to do things. Like if you're just doing living expenses, the traditional deferred's great. You take money out, you pay taxes on it. But if you're going to make large scale purchases, like buying an RV or an extra, I'd say a house, a second home, how would you want to pay for that money using these accounts? Would you want to use your tax deferred account, or what do you think?
Brokerage.
Isn't it a loan against your tax deferred?
You can take a loan up. Okay, I'm not a fan of taking a loan against your any 401k in general. But those loans, you can only take a maximum of 50K anyway, in reality. So, and a certain percentage, I think up to 50% of what you have, but a maximum of 50K. So, and I wouldn't do that as a loan. But what I'm saying, say you want to buy an RV or some really large purchase, that's where you'd want to use some brokerage account. If you use all tax deferred, you could have a huge tax bill that year because you're paying income taxes on all that money. Whereas if you use some Roth, use some brokerage, and maybe a little bit of tax deferred, you can pay much lower taxes and still make those major purchases. Make sense? Here's where too many people are at though. And especially people that are a little bit older typically, because Roth is a relatively new thing. The Roth IRA came out in 1998. And then a lot of 401ks only started allowing Roth recently. So tons of people are sitting here with all their money in Roth IRAs and in traditional 401ks. And then they could be in a real bad situation when they hit 72 and they get these big RMDs that they have to take out or get a 50% penalty. And suddenly they think they're not making income, but they're paying these huge tax bills on RMDs that can consistently go up as percentage goes up as you age, and you find yourself in a larger tax bracket in retirement than you ever expected because you didn't manage this whole these three types of accounts well. Makes sense? Any questions here? Okay, now these, and I really just put these out just for you guys to have, that you'll see in the slide deck. There's, but this shows the current tax brackets. The next presentation I give, where I go into, or actually the lifetime tax management, I compared this to the tax cuts when Tax Cuts and Jobs Act goes away and how that impacts our actual taxable income and tax rates. But this just gives you all of the basic information so that you have that and can see where you're at. Hopefully the SALT tax deduction will go up when they change taxes, but who knows? Right now that's for people especially in California and New York, $10,000, you're talking like property taxes and these other taxes. It's completely insignificant whereas some people are paying $30,000+ in these taxes. So hopefully they increase that deduction, which will go directly against your federal taxes you pay. These are California tax rates, the worst in the country. Amongst the other things. Here's capital gains rates, and this is something that is another thing you can take advantage of when your income's low. Is there's a 0%. Capital gains sit on top of income taxes, so like people that if they retired or say took a sabbatical, say they had no income. A lot of people still have some, whether it's, dividends or rental income or whatever. But if you had none, you could contribute, you could convert, you could sell off enough stock to where all these gains and pay 0%. And I think I know someone in the audience that's actually been doing that wisely. But this is a great way to get your cost basis up and without paying taxes or minimum amount of taxes. Hopefully capital gains rates stay low, but there's threats always of them raising it to closer to income tax limits. But anybody have any questions on this? Okay, I'd like to say investing should be boring. These are the basic actual definitions of what each are. Stocks, bonds, real estate are investments. They have positive expected returns, and you're buying into companies that make products that make profits, and you as an owner of equities, you're an owner of these companies, and you share in their profits with dividends, etc. That's investing. Investing should be boring. Just buy index, mostly low-cost broad-based index funds, and let it ride, and you'll be happy. They're self-cleansing and incredible tools. Speculating, now that's actually where you're just hoping somebody else will buy it for more than what you paid for it. There's no real value. They're not making anything. Gold is an example of a speculation. Crypto is as well. Granted, blockchain, the technology is something that's incredible, but right now just buying crypto is really a speculation. I'm not saying not to do this, but what I'm saying, just explaining what it is. It's still really a speculation. But even studies have shown, like, crypto's too new, but it's very similar to gold in that respect. But as in your accumulation, I wouldn't buy gold myself, but as you get closer to retirement, they've shown that having a certain fraction in gold is good. It just provides that right risk parity diversification when, but gold will go up when other things go down. It provides that negative correlation that you really want as you're getting towards drawdown trading. So less than 1% of people are successful on day trading. And the worst thing almost is you win first, and then you think you're smart, and you're really not. and then you lose your butt later. That best thing, I'm a big fan of buy and hold, shove the money in, spend your time building your talents where you'll make more money and you can invest more instead of losing your butt trying to do day trading. Warren Buffett has been studying companies for like 90 hours a week since he was 10. Do you really think you're going to be better than him? I don't think so. Or all the people that have teams of people, machines faster, working 18 hours a day. It's just not worth it. And then gambling is by definition opportunities to have a greater likelihood of losing money. Okay. We didn't know this last time too. Here's my thought of hierarchy of saving and investing. Get that. If you don't have $1,000, get that, and then as well be building up your emergency fund. But before you even have that full emergency fund, I get that match. And while you're building your emergency fund, that's free money. That's you wouldn't go buy a $20 bill on the ground and leave it there. But too many people do that with their investment accounts, leaving thousands of dollars on the table, which is just terrible. ESPP and high interest debt, paying those off. ESPP, you get 15% immediate discount on the best price. For us, there's a 6-month, say we'll use this example of this year, January 1st through June 30th. The stock prices on January 1st and June 30th, whichever one's lower, we get a 15% discount off of that price and pay, buy that many shares. I'd recommend getting the max of 5%. But I say it's a push between high interest credit cards. Hopefully you guys don't have any credit card debt, because that's terrible. That's using compounding in the opposite way against you. But if you do have, usually those interest rates are 20% or worse. So pay those off. Then max out the IRA and the HSA. Those are more important than, like I said, get the match. So you put in 10%, what we need for our account to get the 5% match in the 401k, but then max out your HSA or IRA before you go back to the 401k, because you've got better options in the IRA, and the HSA has got the triple tax advantage. And then I say kind of overall accumulate wealth. You got your taxable brokerage account, max out your 401k. Real estate, of course, is key, and then paying off your low interest debt, things that are like less than 5%, student loans, mortgages, things like that. Any questions here on this? Does this make sense? Okay, real quick on passive versus actively managed funds. So Vanguard's really, Jack Bogle started the index fund, which is a computer that basically the mutual fund is designed to copy the performance of an index, like the S&P 500, the 500 largest companies in the US. It's run by a computer and adjusts the fund's investments to match that based on a market cap, like how big that company is. Active fund managers and hedge fund managers, they say that the market is not efficient, and that they can move faster and make changes. But so they buy and sell, trying to beat the market. But what the fact is, they fail, and they fail in large numbers. So, and it's weird. I remember first looking, early index funds have become much more popular over the years, but 20 years ago they weren't. And you see these Morningstar ratings for all these funds, these actively managed funds, and you couldn't help but want to buy them. Like, oh, it's 5 stars, but it's all past performance. And as these funds, the longer they go, the more they fail. The next slide I'll get into. My point is, just stick with the index. They win, and the next slide goes into just how much they win. And I'm not going to read all those statistics, but you can just see that. I just have it for you when I send out the slide deck. Warren Buffett put a bet against hedge fund managers. Only one actually accepted the bet, $1 million bet, and he said, over 10 years, I bet I can beat you out by just S&P 500 index fund will beat you out over a 10-year period. And he crushed them. First, none of the hedge fund managers would even accept the bet, except for one or two. And then he crushed them by, like, his overall return was the S&P 500 index fund return over those 10 years was like 85, 80 something percent, versus the hedge fund was like 22%. I mean, just killed them. It was something like $854,000 of earnings versus 220,000. I mean, it wasn't even close. So pretty, bottom line, stick with the index funds. And that's where expenses matter. We're paying for these people's yachts, that actively managed funds. If you had 2% in expenses on a fund over 40 years, assuming an 8% rate of return, which is what the market is a good guesstimate for what the market returns. Your earnings you'd lose over 40 years 50% by paying that, by getting those 2% in expenses, which people with assets under management, along with high expense ratio funds, are paying quite a bit, and it's just devastating their overall return long term. Taxes, you also pay a lot of taxes when these active fund managers are buying and selling. You end up paying a lot more in tax as well. So that's just, fortunately, things have changed over the years. this is a quick look at here's the funds that we have. And I'm not saying the red ones don't do that, but you want expense ratios if you can, like 0.25% or less if possible. Some of these are high. If their return's great enough, sure, but you can also probably buy those outside of the 401k in your IRA and brokerage account for a much lower expense ratio, the same asset basis, basically like say small cap here. You could buy these or the emerging markets, get that allocation of yours in a different account where you're going to pay less than 0.25% and save that much money each year in earnings. But these just show, like sample funds that we have. You notice our target date funds are really good. Those used to be terrible with other ones, but we have Vanguard target date funds. Good for people just getting started. It's simple, diversified account. As you get older, you want to shift that out though. And here's just a quick talk on diversification. You don't want everything in one basket, but the beauty of these index funds, like the total stock market fund, is that's like over 3,600 companies. You're betting on the US and all this, you've got 3,600 CEOs working to make you money. And it's self-cleansing. Companies fail, new companies come in, that these indexes just adjust. Unlike a single stock where you hold it and that company goes out of business, that stock goes to zero. That's not the case with the index fund. Self-cleansing, it's a beauty of it. But there's very different things that you can invest in. I'm not going to go too much into exact allocations, but simple path to wealth is really good. Oh, hey, you got to go. But this shows where the earnings are. It's got good to see you. And let me see quickly go. Yeah, sorry, we're over time right now. Employee stock purchase plan, like I said, we already talked about this. It's great. Take advantage of it. And then here's things. If you need net worth spreadsheet, let me know. But these are things, what I'm saying, take action on this stuff if you haven't already today, and set it up, make things automatic, because you will not do as well if you're not on automatic. We're emotional animals as humans too. And so we'll make stupid decisions when it comes to investing because of loss aversion and other things. So just get things on automatic and you'll be happy in the end. But here's just the other items that I'm saying. Like I said, investing should be boring. You can gamble with a little bit of your money and speculate, up 5 to 10% max, but the rest should just be, sitting in these nice index funds, making you wealthy over the years without you doing anything but making automatic contributions. Here's a quick net worth calculator. This comes from the Millionaire next door, which it's a great showing what an average accumulator of wealth is, and prodigious, which we all want to be prodigious accumulators of wealth, right? The Money Guy show, they actually gave it something for people under 40, which is good, because it's these numbers are hard to achieve for people that just right out of college. But so they provided a little change here where you add in 10 plus your years until you're 40, so it makes a little more sense. But this is good. This is a good check to see where you're at. Are you accumulating enough? And then eventually I'll show you. They do net worth by age and 401ks by age average, and I'll put those up in a future brief so you can see where you're at too compared to the average. The averages are too low though, so I like this net worth calculation better because that's more realistic based on your age and your income. Any questions? I know we're already running over, but any questions or recommendations or?
That's great. Thank you, Alan.
Okay, well, thank you. Appreciate it. And there's a chat I didn't see. Let me see if there's anything. Okay, oh, that was Raleigh. Okay. Well, I'm gonna. That's it for today then. And thanks everyone. And I'll shoot the slides out, and I'll have the recording as well at some point. Okay.
Thank you.
Awesome. Thanks, Alan.
Okay.
Bye.
Thank you. Have a great one.